Hello and welcome to the November edition of CCR Wealth Management's Market Outlook and Webinar. I'm Jonathan Albano. I'm the Senior Financial Planner at CCR, and I'm joined by John Maher, our Chief Investment Officer. We're looking forward to discussing several of the key topics that we're hearing from our clients, discussing some of the volatile markets and events that have occurred over the last few weeks. Certainly, let's just jump right into some of these topics with John. Well, obviously, we're hearing a lot about rising interest rates, and there's certainly many mixed viewpoints in terms of the effects of these higher interest rates on capital markets. John, what should we be looking at in terms of this economic impact?
Hi, John. Yeah, certainly interest rates have been rising. Obviously, there have been 8 interest rate hikes over the last 3 years, and 7 of those have come within the last 2 years. So we've kind of had a steady drumbeat of 25 basis point rate hike per quarter. As you can see in the chart indicated, which actually goes back and gives you a Fed funds history over about the course of about 20 years or so. Concerns about interest rates have been with us for a while. Concerns about interest rates were a topic of our first webinar back in March because they were the cause of a lot of the market volatility that seems to have begun this year or kind of reignited this year. We've had a bout of volatility in February, followed by another bout of volatility in March, and of course, October last month was quite a ride. I think first and foremost, it's important to understand why interest rates are rising. Why is the Fed raising interest rates? And you need to understand that the Federal Reserve has what's so-called dual mandate. So they have 2 jobs they're trying to take care of at the same time. One is to promote price stability, right? Control inflation. The other one is to promote full employment. And to one degree or another, I mean, the story of the last couple of years has been a very steadily declining unemployment rate. As a matter of fact, today we're at near 50-year lows in unemployment, which is fairly astounding. Less so much in the news, but certainly with us has been the fact that the consumer price index, and how we measure inflation, has been very much under control. I mean, ranging at about the mid 2% range. So the story seems to be, you've got full employment, very low unemployment, and you have very steady prices. So the question is, why is the Fed doing this? Jerome Powell came out about a month ago or so, and basically in an interview said that, well, the indication was that there was going to be no pause in the near future as far as the Fed raising rates. I think that might have been the match that lit the flame in October as far as the volatility is concerned. But the question is, given these 2 facts, full employment, under control CPI, why? Why raise rates? So if you go back to our inaugural webcast back in the spring, the word to still keep in mind today is normalization, right? Markets and economies are cyclical. They always have been. They always will be. So the current market cycle we're in, as you can see, and we've talked about it over the last 2 years or so, is currently in its 113th month of expansion. These downdrafts that occur between expansions, it's indicated in the blue on the chart, happen. These are recessions, they're contractions. And the biggest reason to normalize interest rates is because when these contractions occur, generally the Federal Reserve steps in and provides liquidity to the market, and in an effort to both shorten the length of a recession or downdraft and mitigate its impacts. So the Fed does this through interest rate cuts. And the bottom line is that, if you're at 2% or 1.5% or 2.5% from the standpoint of the Federal Reserve, you don't have a lot of ammunition to do that. Normalization is a process getting off the bottom.
So higher interest rates is essentially putting additional arrows in the Federal Reserve's quiver. What is the likely impact of higher interest rates?
Right. So higher interest rates always have the impact of slowing the economy. Much of the market volatility we've experienced, certainly in October, again, go back to February, but in October particularly, maybe stemmed from Chairman Jerome Powell's comments in a news conference that it was pretty unambiguous that the Fed had absolutely no plans, at least not in the near term, to pause their program of raising interest rates. And again, normalization, raising interest rates off the bottom. But, you know, look at the facts. The facts are that you've got 8 rate hikes in 3 years, 7 over the last 2 years, and gross domestic product, GDP, is still coming in at 3% this year. I think it was 3.5% for the prior quarter, and unemployment is at historical lows. So what gives? The bottom line is, I think that what's happening here is the tax cuts and some of the deregulation programming from the administration over the last couple of years has really done the job of masking some of the effects that higher interest rates would normally have on business. If you check out some of the more recent data that's been cited in the media, and I'm going to cite housing starts, you know, some view housing starts and the real estate industry as sort of the canary in the coal mine. And we've seen a drop recently in housing starts. We also know that mortgage rates last month, for the first time in I think it's since 2011, rose above 5%. And that's been, again, that's been cited by the media. It's been cited by some other financial firms as evidence of a slowdown, maybe evidence that interest rates are in fact having an impact. The direct link between the two, in my view, and this is my view, I think is a little bit premature. I mean, we have to recognize housing starts as important concurrent data. Housing starts are viewed by the market as an important leading economic indicator. And housing is important. I mean, 27% of capital spending is attributed to home building and construction. Housing represents 5% of the economy overall, so it's important data. But I think connecting a 5% mortgage rate to what can be a more volatile indicator is maybe a little bit premature. I mean, I think that we could probably survey our clients, at least clients above a certain age, and we'd find out that almost everybody, at least at some above a certain age, has had a mortgage over 5%. The other thing about housing starts is that we can zoom into instead of looking at a 20-year chart, we can look at a 1-year chart and find out just how volatile housing starts can be. So I believe it's too early to be calling rising interest rates, you know, currently as some kind of a nail in the end of the current expansion. So I think as I've said in outlooks previous this year, that, you know, interest rates will very likely be felt more in earnest next year. We've had the fiscal stimulus, right? The corporate tax reform, tax cuts. Fiscal stimulus is a temporary measure, right? It wears off, and you know, as investors are currently in awe of what really is going to amount to about a 24% increase in S&P 500 earnings this year, you need to understand, we get into the first quarter of 2019 when, you know, earnings start getting released in April. The year-over-year comparisons are going to become a lot more difficult, and I think those difficulties are going to increase as each quarter goes on next year. You know, you're going to start to feel the effect of higher interest rates. It's going to seep into the cost of capital. It's going to seep into probably compressed profit margins in the future. And the market's looking at that right now. I think the market it's a forward-looking mechanism, and I think that's the source of a lot of volatility we've experienced over the last 30 days or so.
Okay, last question about interest rates, but it's obviously been a persistent theme throughout this year. If there's a consensus for higher interest rates and bonds are negatively impacted by higher interest rates, why would anybody want to own bonds in their portfolio? And additionally, help us understand why bonds are impacted negatively by higher interest rates.
Okay, so sure. Let me answer the second question first.
Okay.
So I borrow money from you today at prevailing interest rates. and let's say I pay you 4%, right? So this loan to you, you can sell this loan to someone else. It has resale value. Fast forward a year, interest rates have gone up, and once again, I borrow money. And at this time, I'm paying 5%. Maybe I'm paying 5% to someone else I borrow from. Which loan has more value? The loan that pays 4% or the loan that pays 5%? Well, obviously, the 4% loan has declined now that 5% loans are available. It's declined in value. So that's a really simplistic, perhaps overly simplistic answer to why bonds decline when interest rates rise. And there's plenty of other things that go into, other factors that go into bond pricing. But that's basically the gist of it. So we've been telling our clients and I think you could probably go back the last 8 or 10 outlooks, that our expectations out of the bond market has been generally 0 to 2%. Now we're talking about the bond index, right? The Bloomberg Barclays Aggregate Bond Index, but 0 to 2% for quite a long time. So why own bonds? The answer is October, March, February of 2018. Quite simply, even when the cause of volatility is interest rates, bonds are still less volatile than stocks are. So I know we've had a number of client conversations earlier this year where some folks have not been thrilled with the bond market, and you understand that maybe larger chunks of their portfolios, could be 40%, could be 50%, might even be more, have been tied up in fixed income according to their agreed upon asset allocation. So we have a lot of clients who were not particularly happy with the portfolio return as the stock market is going up back in the summer. Fast forward, when the S&P is down as much as 10% last month, parts of the NASDAQ were down as much as 20% and even more in the month of October. If your portfolio was only down 4%, 6%, 5%, you can thank the fact that you own fixed income, that you own bonds. And why is this important? It's very important. It's particularly important if your portfolio is currently providing cash flow. All right. So just as a matter of math, if you lose 20%, what do you need to get back to break even? Just to get back to the point where you started, you need a 25% rate of return. That kind of volatility is not something I would say most of our clients be ready to handle. But again, importantly, to repeat myself on this issue, if the portfolio is providing cash flow, right, that kind of volatility can do lasting damage. It can really shorten the life of the portfolio, and that is the point of asset allocation. Importantly, it's not trying to chase which asset class is outperforming now or over the next 6 months. I say this from 2 decades of experience. I mean, I know we have many clients who, not only were they dissatisfied with bond portfolios in the summer, but a lot of those clients, and I think some of the same clients, might have even made phone calls here in October wanting to get rid of their stocks. The implication being, if you don't like bonds in August, then get me more stocks. So we try to avoid chasing returns in that respect. So the answer to the second question is one I tried to address in last month's email, right? We're talking about bonds as an asset class, bonds as an alternative source of return in a portfolio. Bonds generally have a lower correlation or a low correlation to stocks. I wrote about the fact that institutional investors understand this inherently. We talked about pension funds and insurance companies and banks, institutions that manage very large sums of money. Okay, and these are institutions that have a required rate of return they need to achieve. I mean, these guys are not just winging it.
So similar to our clients in terms of their required rate of return.
Exactly. I mean, they're not winging it. They're not jumping from asset class to asset class. And in a kind of a seat of the pants method and based on what somebody just said on CNBC and making wholesale shifts. So over time is the operative word here when we start talking about required rates of return. They didn't jump out of stocks on October 3rd and just file into bonds and then reverse themselves 30 days later. It doesn't happen that way. As crazy as it seems, at least to us anyway, as financial advisors, many individual investors do that or think that they should be doing that, or in some cases may even expect us to be doing that on a wholesale basis. And it's a significant contributing factor to why, and studies have shown this, and we can illustrate this through fund flows, but why individual investors quite often have dismal rates of return over the long term. So investors have a tendency to buy high, and they're buying what's already gone up, right? And we've been around the block long enough to understand that, you know, interest gets peaked in Apple Computer after Apple's already doubled in price. They have a tendency to sell low. And this is just generally speaking, we're talking about as individual investors, not necessarily our clients. Recall the piece we put out a couple of years ago, we're highlighting behavioral finance issues and the Dalbar study. The Dalbar study results are on the chart below. So above, you have a comparative return associated with an asset allocated portfolio, in this case 60-40, relative to the S&P. Below, the chart below, you know, it's a pretty stark comparison between the average return of individual investors, indicated on the right in orange, and each market sector, and certainly hypothetical towards the left of a hypothetical 60-40 portfolio. We know this information pretty confidently through fund flows, as I mentioned. You know, and also last month we wrote about pension plans and roughly the rough idea of how much pension plans keep in stocks and how much pension plans keep in fixed income. And I mentioned pension plans because the objective of a pension fund most closely matches what our own clients are trying to accomplish, and that is to provide a future stream of income for life. There's no easier way to screw this up than to try to take advice off a daily watching of CNBC. As you can see, the average bond allocation in a corporate pension plan is north of 40%. Now look at the pension return assumptions, and these are important. 6.6%, which is the current average assumption of a pension plan, is quite close to our own financial planning projections, our own financial planning assumptions. And in my opinion, 6.6% is probably still too high. But look now at how they've fallen from where they were 20 years ago. You know, back in the 1990s, return assumptions approached what was then the long-term track record of stocks. So what happened? Well, obviously, the year 2000, 2001, 2002, 2003 happened. And certainly there was, of course, the financial crisis back in 2008 and 9. When you badly miss your assumptions, as a pension fund, you become what's known as underfunded. You know, these plans didn't, and many still don't, have the assets to fund their future obligations. And they are obligations. I mean, they're legal obligations under ERISA. And there's other factors that go into why their assumed rate of return was too high to begin with. Some of that has to do with the manipulation ability on an income statement that can coincide with pension accounting. But that's outside the scope of what we're talking about. So our clients' investment objectives are obligations. And if we can go back to the periodic table, you know, lurching from asset class to asset class and expecting to do it successfully is unrealistic. Each box in this graphic represents a major asset class, and its rankings by performance in each year going back about 15 years. You know, the columns on the right are interesting, and we pointed that out in the outlook, so I won't belabor the point, but what we're doing is trying to seek a required rate of return, but doing it with the least amount of volatility on a portfolio level. And that is ultimately, you can't do that with a single asset class. You can't do that by just skipping around the stock market.
Switching gears entirely, John, in recent weeks, particularly from clients who tend to pay closer attention to the markets, been fielding a lot of questions about why during particular times of day is there increased volatility within the stock market. Most notably from 3 o'clock to 4 o'clock, for example. There tends to be wild swings in terms of the direction of the market, regardless of what the news events of the days have been.
That's a good question, and sometimes it's true. I mean, sometimes there is an increase in volatility, and it comes late in the day. And there is a good reason for it. It's a technical reason, and I promise you I will spare you the technical details. But it really has to do with the fact that a large and increasing proportion of trading that's done on the exchanges is done with computers. What most what most algorithms are doing is actually trying to seek best execution. So for example, if you're an institutional investor, if you're a mutual fund and you want to make a swap from IBM stock to say Microsoft stock, and it might be $10 million, it might be $25 million, it could even be close to $100 million. That size of a trade, you're not just going to dump onto the market with a market order, right? That market order would create so much supply, you'd end up moving the price, and in the process, you're really going to compromise your trade. Most of the time in the past, what would happen is that traders would do something called working the trade, and that trade would get executed via brokers or via contacts from the trading desk, and it may be done in a day or it may be done over the course of a few days, but it all depends on what the motivation of the trade was, number one, and number two, it's a matter of finding other participants that are willing to transact in your desired price range. These days, a very large portion of trades that are done on the exchanges are done with computers, they're done with algorithms. I'd say, by the way, we've referenced CNBC. That background of CNBC when they're at the New York Stock Exchange, that's a lot of that's just for show. I mean, it's not to say they don't do anything there, but they certainly don't do next to nothing on the New York Stock Exchange compared to what happened there 30 years ago. They wouldn't allow them on the set. It was too busy. I've been there. So a lot of that is staging. So for those large trades, and there's many of them on a daily basis in our very large and liquid market, you have trades that are being broken up into smaller bite-sized pieces and rapidly seeking execution using algorithms. So there are basically two types of algorithms. I'm just really simplistically, there's a lot more than that, but we're really narrowing it down to motivations for the trade. These algorithms operate across what are called electronic crossing networks. And even though I mentioned the New York Stock Exchange, the floor of the New York Stock Exchange, there's not a lot of activity there as much as there used to be. The New York Stock Exchange itself is one of the biggest electronic crossing networks in the world. So you have algorithms that basically are seeking speed, right? Speed of execution. And you have algorithms that are seeking the best execution, best pricing. Right, so the motivation for a trade could be as different in both cases. If you're a trader or if you're a portfolio manager, if you believe that you have information that is unique to you, that you've stumbled across something that nobody else knows, and you want to do that trade quickly, right? So there's trading algorithms that will seek to execute your large trade, but they'll have a bias to doing it sooner in the day rather than later in the day. Even though they're chopping, they too are chopping that trade up into manageable pieces so that you're not moving prices around so much. Logical participation strategies are the other type of trading algorithm. These seek really the best price. These are liquidity motivated trades or value motivated trades. And they tend to really seek to go with the flow of the market, the way the market's going that day, right? So they're not necessarily trading soon in the day or later in the day, but they're moving with the flow of the market on that day.
So they can push the market around.
Right. So when you have a volatile market, and you've got logical participation strategies that have yet to fill out their daily trade, and the market is down or it's volatile, they're finishing those trades, and that can sometimes, create an extra swing up or an extra swing down in the market. I would use yesterday as an example. Market was up most of the day yesterday. Yesterday was the day after the election, and we had a positive price movement most of the day. But what you saw around 3 o'clock, and my point of bringing this up is that it's not just downside that this can happen, it's also upside. We went from being up about 300 or so on the Dow to being up 550 at the end of the day. So that most of that move happened in the last hour and a half of the day. So whatever the trend tends to be, a lot of those algorithms will kick in and really just reinforce that trend.
John, in the news everywhere is the topic of trade negotiations. Question for you, obviously, is are these negotiations affecting the economy? And are you concerned if these discussions are prolonged and are carried out over an extended period of time?
I think it would take a significant escalation from the measures we've already seen for the current trade spat or the trade situation, be it any kind of a major global economic trigger. Again, I don't like the term trade war. I think it's a misnomer. But at the same time, I will admit that the lack of any development with China thus far in this process, maybe it's a little bit bothersome. Elections behind us. That may come into play, so we'll wait and see. But the reality is that history does not provide much of a guide as to the likely effects of the current economic spat, at least not in terms of possible specific economic outcomes. The U.S. escalated trade tensions or trade protection for a time back in the 1970s. I think today it's referred to as kind of the Nixon shock. And also the 1980s, President Reagan instituted a policy of what was so-called trade restraint. If you take a look here, worldwide trade volumes continued to rise during both periods. And the effect of on global GDP was negligible. At the same time, however, both episodes were short-lived. And they were not met necessarily with large escalation by our trading partners. So I think the major issue as it pertains to the U.S. Risk of escalating tariffs is to the supply side of the economy. So take a look here. I mean, major economic efficiencies were brought to the global market through specialization and the disbursement of supply chains, which increased global trade in what are known as intermediate goods. Essentially components of finished products. I think a perfect example is your iPhone. The display of your iPhone is manufactured in Japan. The camera on the iPhone is manufactured in Germany. The blue chip in your phone is manufactured here in the U.S. The processor in the phone is manufactured in South Korea. And the whole thing is assembled by a Taiwanese company that's located in South China. So as you can see, it's a fairly complex supply chain, and this permeates many other sectors of the global economy. I think another big one impacted or with potential impact of supply chain disruption is certainly the auto industry. But it's not just autos and cell phones. It's quite a few manufacturing sectors. So I'll go back to our original thesis here, and that is the trade rhetoric is a negotiating process. And in that I include the tariffs that have been enacted already. The fact of the matter is most people who have been paying attention to this have seen, that finally we have Canada and Mexico on board with the U.S., at least on a preliminary basis. Now they need Congress and politics, aside. They seem to have ironed out the whole NAFTA reform. The European trading partners and the U.S. have sort of called a truce to things, but we do believe there's progress being made. So not a lot of tariff retaliation there, at least not now. This is a negotiating process. The sticking point is, of course, China. Look, China is not a democracy. So there is a question about just how much the leaders of China, or the leader of China, could potentially be willing to put their people through in terms of economic pain. We know here in the U.S., given our political cycles every 2 years, that there's a lot more vulnerability to our politicians from actually enacting policies that'll have a significant negative economic effect. So it's difficult to gauge. They don't have popular elections. Ultimately, I think it's going to be a matter of both sides trying to find a face-saving way out of this. But we don't expect a whole lot of major revolutionary differences in the trading, in the current trading arrangement. So John, things may change, and we're going to modulate our strategy accordingly. But at this point, rather than the trade rhetoric or even the current tariffs that are in place, I think this economy has other things to worry about. I mean, from my perspective, and I don't think it's really so much showing up in the macro data yet, but I think worker shortages in this country is potentially a bigger threat to the economy. I certainly think interest rates are a bigger thing to be considering with a portfolio strategy or an asset allocation consideration rather than the trade rhetoric.
John, thank you for your commentaries today. We certainly appreciate everybody for tuning in. We appreciate our clients for taking interest in the discussion that we had today. We look forward to providing these types of webinars in the future. Thank you very much.